If you want to know whether you should pay off your mortgage early or invest instead, stop pretending this is only a math problem. It is not. It is a life structure problem that happens to use math as the language. That is the first thing I would want you to understand. People love to argue about this question as if one side must be obviously right. One camp says debt is poison, kill it as fast as possible. The other says cheap fixed. Rate debt as a gift, keep it forever, and let your money compound elsewhere. Both sides usually say it with great confidence. Both sides are also usually smuggling in assumptions they do not bother to name, because the real issue is not just what return you might get. The real issue is what kind of financial life you are trying to build while you are waiting for that return. That is the mother line. A mortgage is not only a number, it is a fixed obligation attached to your shelter, your monthly cash flow, your stress level, your ability to survive bad timing, and your flexibility later in life. An investment account is not only a number either. It is optionality, it is future growth, it is uncertainty, it is volatility, it is a claim on compounding that may reward patience generously if you have enough time and enough emotional control not to sabotage yourself halfway through. That is why this debate gets so emotional. People think they are debating percentages. They are really debating two different visions of safety. One vision says safety comes from owning the roof over your head free and clear. The other says safety comes from keeping your money liquid and growing, while you let cheap debt get smaller in real terms over time. Both visions contain truth. The trick is knowing when each truth matters more. The source document does a good job of stripping this question back to the real comparison: pay off the mortgage, and you earn a guaranteed return equal to the mortgage rate, invest instead, and you accept uncertainty in exchange for the possibility of higher long-term returns. That is the basic trade. But I do not think the most important question is, can the market beat my mortgage rate? The more important question is, does this debt make my overall plan stronger or more fragile? That is the first mechanism I want you to understand. I call it the fragility test. A mortgage at 3% means one thing. If you are 35 years old, steadily employed, aggressively investing, sitting on strong cash reserves, and decades away from retirement, it means something very different if you are 61, planning to stop working soon, carrying large fixed expenses, and depending on your portfolio to support your life. If markets choose the wrong moment to misbehave, the interest rate did not change, the fragility did. That is why I never trust answers to this question that only quote one number and ignore the rest of the balance sheet. Now, if we do start with rate math, a very clear pattern appears, and the source text is right about that. There are really three broad zones: the mortgage zone, the gray zone, and the pay it off zone. When the mortgage rate is very low, generally somewhere around 0 to 4%, the arithmetic leans heavily toward keeping the mortgage and investing excess cash instead. Historically, broad equities have earned far more than that over long periods. Even conservative balanced portfolios often competed favorably against debt in that range. And inflation quietly helps you too. A fixed payment attached to a low-rate loan becomes easier to carry over time if your income rises and the dollars you use to pay it back lose purchasing power. That is a beautiful kind of debt. Not because debt is morally good, because it is economically cheap. This is the second mechanism. I call it declining burden debt. Most people think of a mortgage as a weight that stays the same until it is gone. But that is not how low fixed rate debt behaves in a living economy. If inflation averages 2 to 3% and your mortgage sits around 3%, then the real cost of borrowing is barely above zero. The nominal payment does not change, but the economic burden often shrinks over time relative to your income. And the general price level, that means a low-rate mortgage can actually become less dangerous the longer you carry it, provided the rest of your finances are strong enough. That is an important condition. The rest of your finances must be strong enough, because cheap debt is only beautiful if it is not sitting on top of a weak household. Now let us move into the middle, because this is where life gets interesting and where most honest answers live. The gray zone is roughly 4 to 6%. This is where the simplistic people become useless. At this level, the spread between what you pay and what you may reasonably earn after tax, after inflation, and after risk starts narrowing. Once the spread narrows, behavior matters much more. The difference between guaranteed and uncertain returns matters more. Sequence risk matters more. Taxes matter more. The fact that your portfolio return may average 7% over a long horizon does not mean it will politely deliver that return in the exact years you need it. That is the part many people hate to hear. Average return is not the same as usable timing. This is the third mechanism. I call it the risk premium illusion. People see a mortgage at 5.5% and say, the market earns 7% or 8%, so of course I should invest. Not so fast. That extra 1.5% or 2.5% is not free. It is what you are being offered for tolerating volatility, drawdowns, tax drag, and the possibility that the market behaves very badly at exactly the wrong stage of your life. The farther you are from needing the money, the more tolerable that bargain becomes. The closer you are to depending on the money, the more carefully you need to inspect what you are actually being paid for the risk. This is where age matters. The source document uses a 35-year-old and a 45-year-old with the same $400,000 mortgage at 6.5%. And that is useful because it shows how one number can belong to two very different decisions. If I am 35, I still have something extraordinarily valuable: time. Time to compound, time to recover from volatility, time for earnings to rise, time for the burden of the mortgage to change shape relative to my total financial life. At 35, the most valuable dollars I will ever invest may be the dollars I invest right now. $1 compounded for 30 years behaves very differently from $1 compounded for 15 or 20. The mathematics of early investing are almost unfair in how powerful they are. That is why I would be very cautious about sacrificing too many prime compounding years just to eliminate a mortgage faster, even at a rate like 6.5%. Not because paying off the mortgage is wrong, because time is doing something rare for me at 35 that it will never do for me again. This is the fourth mechanism. I call it the early dollar advantage. A young investor who diverts too much capital away from long-run compounding in order to achieve emotional relief from debt can accidentally make a very expensive trade. He gains certainty earlier, yes, but he may also give up the years when invested dollars have their greatest chance to become multiples of themselves. That is not a trivial sacrifice. And it is why at 35 I usually lean toward protecting compounding first and then attacking the mortgage second, not ignoring the mortgage, but not letting it consume the years that matter most for asset growth. Now compare that to age 45. At 45, time is still useful. It is just no longer abundant in the same way. Retirement is no longer a distant myth. It is a visible date. Market losses have less time to heal. A large fixed expense carried too deep into later life can become more dangerous. The issue shifts from pure maximization toward planned durability. That is a very different assignment. At 45, I still want to invest. I am not suddenly anti-market, but I am much more open to deliberately accelerating mortgage payoff because I care more about reducing future withdrawal pressure and fixed obligations before retirement begins to dominate the conversation. That is the fifth mechanism. I call it the resilience turn. As you age, the question changes from how do I maximize long-run wealth to how do I make the whole structure harder to break. A mortgage is not just interest expense at that stage. It is a claim on future cash flow. It is a mandatory monthly obligation that will not care whether markets are down, whether your portfolio is suffering, whether your sequence of returns is ugly, or whether retirement expenses are tighter than expected. That is why older investors should be much more suspicious of elegant spreadsheet answers that ignore real-life fragility, because fragility is what ruins plans. Now let us work through the actual example from the source material, because this is where the trade-off becomes concrete. A $400,000 mortgage, 30 years, fixed at 6.5%, produces a payment around $2,500 a month. Over the full life of the loan, the total paid is a little over $900,000, which means more than $500,000 goes to interest. That is real money. So when someone tells me adding $500 a month to principal in the early years can save more than $100,000 of interest and cut years off the loan, I do not dismiss that. That is not some symbolic victory. That is serious. But now compare it to what the same $500 could become if invested early and left alone long enough. Compounding turns those monthly decisions into far larger future values than most people intuitively appreciate. That is the psychological trap of this whole issue. The mortgage savings are visible. The portfolio upside is invisible for a long time. Humans tend to respect what they can see and discount what they must imagine. That is a dangerous bias. This is the sixth mechanism. I call it visible certainty versus invisible growth. Paying down debt feels satisfying because the result is immediate and concrete. The balance is lower, the future interest is lower, the finish line comes sooner, you can see the progress. Investing feels weaker because the reward arrives later and is mediated by market volatility. The account rises, falls, confuses you, tests you, and asks for faith before it offers proof. That is why some perfectly intelligent people choose mortgage payoff Even when the market math may still favor investing, they are not always being irrational. Sometimes they are choosing a reward structure their psychology can actually live with. That matters too. I never make fun of peace of mind. People who do that are usually worshiping spreadsheets and forgetting that human beings are the ones who must live inside the plan. If paying off a mortgage gives a household deep emotional steadiness, better sleep, stronger control, and less fear of job loss or market chaos, that has real value. You cannot easily quantify it, but you would be foolish to pretend it is worthless at the same time. You should be careful not to overpay for emotional relief. Some people pay off a 2.75% mortgage and call it safety when what they really did was kill one of the cheapest liabilities they will ever hold while reducing their liquidity and long-run compounding power in the process. That is not always wise. So where does that leave us? It leaves us exactly where most mature financial choices live, not in absolutes, in priorities. If your mortgage is very low, your liquidity is strong, your time horizon is long, and your plan is robust, keep the mortgage and invest aggressively. If your mortgage is high, your time horizon is shorter, your plan is sensitive to fixed expenses, and your ability to recover from bad market timing is declining, paying it down or paying it off becomes much more compelling. In the middle, you do not need religion. You need strategy. That is why I like the hybrid approach. The source text mentions the gray zone does not force all or nothing behavior. That is one of the great mistakes people make in personal finance. They imagine maturity means choosing one side and rejecting the other completely. Very often maturity means splitting the problem. Some extra dollars go to the market. Some extra dollars go to principal. The portfolio still compounds. The debt still shrinks faster. Regret is reduced because you are not making one irreversible all-in bet on one view of the world. That is often a much more intelligent way to live. This is the seventh mechanism. I call it dual-track resilience. A hybrid strategy works because it respects both truths at once. The market probably offers more upside over long periods, especially when time is generous. Mortgage reduction offers certainty, fragility reduction, and fixed expense relief. If you can advance both tracks at once, especially in the gray zone, you often create a plan that is not perfectly optimized for one variable, but is much better optimized for actual life. Actual life is what matters. No one lies awake at night bragging that their spreadsheet was theoretically perfect while their real world is fragile. The best plans are not always the mathematically purest. They are the ones that keep working when life gets messy. That is what I care about most. So here's where I come down. When rates are below about 4%, I usually favor keeping the mortgage and investing unless the household has some other major weakness. When rates move above about 6%, especially as retirement gets closer, I start favoring more aggressive payoff because the guaranteed return, the reduction in fragility, and the lower future withdrawal burden become hard to ignore between 4 and 6%, and even a little above that depending on age and balance sheet. I think the honest answer is usually some version of both. Not because I want to avoid conviction, because reality is mixed. The real question is not which side wins the debate. The real question is which choice makes my entire financial life stronger from here. That answer may be growth, it may be control, it may be both, but if you ask that question honestly, you stop treating the mortgage like a pure math object and start seeing it for what it really is. A lever inside your life, a lever that can create flexibility or fragility, depending on your stage, your temperament, your liquidity, and your need for certainty. That is the decision. Not just whether the market might earn more, whether the structure you choose will let you live, invest, retire, and sleep in a way that still works when the market disappoints. Inflation surprises, or life refuses to follow your spreadsheet. That is what the data is trying to tell you if you read it correctly. And that is how adults make this decision.